Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, January 17, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And we had a down day across the board today. In fact, a couple of the indexes got hit pretty hard, some not so much. The S&P was only down about 1/3 of 1%, and the Dow was down about 1/3 of 1%. But the NASDAQ was down double that, the transports were down significantly more, and the broker-dealers really got taken out behind the woodshed. So we'll see if there's an underlying theme developing here, but let's focus on the SPDRs, and we'll populate through there. So when you look at the daily chart of the SPDR, there really is still a bullish pattern developing. All we did today was to come in and retest the daily chart 20-period moving average, which came in at 225.88. We pierced through that a little bit and then bounced off that towards the end of the day. So on the daily chart, there really is nothing wrong. But one thing we do need to keep in mind is what's going on this week. A, we have a compressed week. B, it's options expiration week. So the fact that we have a compressed week and it's options expiration week, understand that now we have 4 days to make what normally the traders would have 5 days to make. And these are on the proprietary trading desks, the options desks. These are the folks that move stocks one direction or another during the week of options expiration week in order to make the retail investor who's bought puts or calls, they make them expire worthless as much as they can. And that's just what the institutions do during options expiration week, among other things. So with that being said, the question is, are we bullish or are we bearish? Or should we be bullish or bearish the market? On one hand, on the daily chart, it's a bullish pattern that's developing. We had an up move and we've just been going sideways. And generally speaking, sideways consolidation generally means another leg higher in a case like this. That would take us to new highs. However, we do have an important number on the charts, 226.59. 226.59 is an extremely important number. We keep closing back and forth. Below it, above it, below it, above it, on it, above it, below it. So it's very difficult to get a read on exactly what's going on. Today we're below that number. That leaves me on a closing basis from today in somewhat of a bearish position. I have somewhat of a bearish bias. Where does that bearish bias turn bullish? Hourly closes back above 226.59. 1 hour, okay. 2 hours, the bull side is in business. 3 hours in a row, and the market will turn bullish and likely continue higher. A couple of the other things we have going on this week is we're really going to start getting a flurry of earnings coming out. That will have a tendency to move the market in one direction or another. When you have the big global companies and the large cap companies reporting, they will and do have a tendency to move the markets. So we're going to start seeing a lot of earnings coming out, so that'll add some volatility to the market. We also have the inauguration later this week. There's been a lot of tension around the presidential election, in between the election and the inauguration. There's all kinds of push and pull on both sides of the aisle. So there's no telling what kind of tweet can come by and actually jolt the market in one direction or another. So that's just something we cannot anticipate, but something that we need to be aware of. So let's take a look around and see where we can get some more clues on other markets, because as it stands, from the naked eye, the S&P looks bullish on the chart. We did close below an important level, so that kind of puts it in a somewhat of a bearish bias, but it's a bullish pattern. So there's a divergence within the chart itself, even on the daily chart. So let's go ahead and look forward to see what else we can find in other markets. The first thing I'm going to look at is the IWM. So the IWM came down about 1.33% today. That's a pretty good decline in the IWM. So the IWM, while still in the larger picture is making a bullish pattern, today was relatively weak, and if any indication is an indication of the weakness found today in the IWM, then we have to be on guard for more weakness leading into tomorrow. So the IWM is telling us potential weakness going forward. So on the spider, we have a bullish chart pattern. We finished below an important number, and we have a significantly down day, bearish indications leading us in the IWM. So basically, we're 2 and 1. 2 bearish things, 1 potential bullish thing, but not so much. Let's move along and take a look at the transports. The transports really got hit pretty hard today, down over 100 points, over 1%, and you can see what happened on the last trading day, which was Friday. We had a pretty good rally in the transports, popped back above and closed above pretty convincingly the 91.42, and today right back down below 9100 on a closing basis. So we're back in a bearish formation as far as I can tell in the transportation average. That's one of those additional items in the bearish camp or on the bearish side of the ledger. Very weak in the transports. We also have some transportation companies reporting earnings this week. So that's going to move the transportation average in one direction or another. And generally speaking, the transports have a tendency to be a leading indicator of the actual or global economy. Pardon me, not necessarily global economy, although it does apply, but the U.S. economy. When you have the railway stocks and the airline stocks all reporting and comprised of the transportation average, that should be and generally is an indication of where the economy is going. So if we do see a negative reaction in the transportation stocks, then we can assume that we're going to have more downside in the broader market. And on the flip side, if we see a positive reaction in the transportation stocks, then we can look for a positive reaction or a lift across the rest of the markets as a result of the transportation average being a leading indicator. Today, transport's down, bearish side of the ledger. Today, we're going to take a look at the financial stocks, the XBD, which is the broker-dealer index. Why? Because it was down 2.5% today. I think that's a good enough reason why. We flagged the 214.35 as good resistance to the market. That was some time ago. That has proved resistant to the market. But the type of down day we saw today is generally an indication of more things to come. So when I say that, and we have financial stocks that are weak today, and without the financials, the market, the broader market, definitely has a difficult time rallying because you need the financials in order to lift the market and rally the broader indexes or the broader markets forward. If the financial stocks are headed in the other direction, that's generally a sign of more weakness to come, although on one hand, we did see higher bond prices today, lower yields. Lower yields generally mean compressed margins for financials, but that's a one-day wonder. I think there's something of a larger issue going on in the financial sector, so I'm taking that as more of a cue of more of an impact on the broader markets than just a one-day wonder. The broker-dealer index down 2.5% today has me at least looking at the markets with eyes wide open. So we looked at the spider, the IWM, the transports, and the broker-dealers. And everything, in my view, points to more trouble coming, at least in the short term, in the market. Now, when I say that, understand that if we get a pullback in the market A pullback is going to or meant to be purchased or bought because we do have and should have another leg higher in the markets, at least leading into February and beyond. Well, whatever pullback we see, whether it's before the inauguration or after the inauguration, should be just that, a pullback that should be bought or meant to be bought for higher prices coming later. So before we wrap up the actual stock market indices, let's just recap of where we are and where we could possibly go in both directions if we get a breakout or a breakdown. So a breakout is pretty simple. If we start breaking out above 226.59 and continue to move higher, we're going to make new highs sooner than later. And if we started that earlier, like tomorrow, meaning Wednesday or Thursday, then likely we're trading up into and through the inauguration, and then we would be looking for a correction thereafter. If the market breaks down and we continue to break down and trade through 224.66 on a closing basis, meaning if we close any day below 224.66, then the game will be on for all the way down for the market to test 220, 219.56 is actually the mathematical number that I have. So call it 219 to 220. It seems far away, but if we begin closing the day below, or closing a day or multiple days below 224.66, then I think we can trade down to 220 or slightly below in rapid fashion. So that's what we want to keep our eye on the downside. If we get back above 226.59 and begin to trade higher, new highs are coming sooner than later. So we know the downside, we know the upside. We have a game plan. All right, let's go over to the gold market because we saw another nice big up day in the gold market today. And the question is, how high and where are we? How high, I'm not changing the number that you see on the chart. 225 would be the top end. Maybe it's 220 on the upside. I think we were already there earlier today. We made a high of 1218.90, and I'm looking for a top end on this rally of 1225. Whether we get there or not, we certainly came close. I thought we would need to consolidate for a while, and then we would be able to push higher. Instead, we kind of woke up Sunday night into Monday with the gold market trading higher, and therefore never really gave us a chance or a sideways consolidation or a pullback. No lower prices. That was it. So what I think is going to take place is either from these prices or slightly higher up at 1220, 1225, we should see some kind of a reversal take hold sooner than later. If and when that happens, we're going to be looking for the gold market to work off some of the overbought condition. It's going to be very, very difficult for the gold market to trade above 1225 without a ton of power, a ton of energy behind it. Right now, that would have to involve some kind of an exogenous event to hit the markets. As it stands now, just on merits alone, gold should pull back. It's overextended on a short-term basis and needs to consolidate, needs to work off some of the overbought condition. Silver had a nice big update today, up almost 3%. And you can see where we are. We mentioned the next stopping point on the upside was where? 17.25 and then 17.5, and then we'll go up to the 200 period moving average, which comes in right under $18 per ounce. Big day for silver, no doubt about it. Short-term overbought into a lot of resistance. There's a lot of chart resistance in this zone. When you take a look at the consolidation that occurred here and here, these are points where the chart will find and is finding resistance. It's my take that we're going to have to see a pullback, consolidation, or at least buy some time off the clock, just like gold, silver is going to need to work off some of the overbought condition. However, based on a daily chart closing basis, we know that the extremely important number was getting above and closing above 17. And we did that today. So we may back and fill a little bit down to 17, even slightly below, but take it as a bullish sign that we closed above $17 an ounce. Keep in mind, we need to confirm. A confirmation is a close above today's high, and certainly we could be at the next target higher at that point, but that's just the way it works. That's the way I read the markets, based on confirmation signals. Sometimes it's too late by the time we get a confirmation signal to do anything about it, but that's just the way it works. You just want to know these rules one way or the other. Tremendous day in silver, any way you look at it. I know some of you are long the GDX and other vehicles that go along with it, so we saw another 3% up day today, and the question is, how high are we going to go on this move? Now, we're into a lot of resistance right where we are. Maybe there's room to 24 on the upside, but the way I see it, with gold in the position where it is, silver in the position where it is, and the mining stocks were in the position where it is, or they are, I think 24 is really going to be difficult for the GDX to get through. So anybody that's long the GDX needs to be A, at least thinking about or taking profits here, and B, trailing your stop, or at least understand where you don't want to own it anymore. And let me give you one idea of where that area is. Before I do, understand, just because I say it's going to have a difficult time getting through this area, that's meaning without a pullback, without a meaningful pullback or consolidation. I'm not saying it can't go higher later. I'm just saying it shouldn't go higher now. There's a difference. What will happen tomorrow and the next day and into next week is one thing. What I'm telling you is, based on the technicals, based on the chart, what should happen and what my expectations are. What should happen is it should work off some of the overbought condition. That's what should be happening. It can get up to 24, but it's a less likely scenario. So any move higher up toward 24, and traders that are long GDX want to be selling some of that into the strength. Could it go higher? Of course it could go higher. I'm telling you, based on the highest probability scenario today. This is a bullish pattern that generally will play out to the upside, up move, sideways consolidation, but this is going to stall out here or right up here at 24.75 to 23.75 to 24. Tons and tons of resistance up in the 24 area. For those of you long GDX. Let's take a look over at crude oil to see what we find there. Crude had a back and forth day. It was up, it was down, and it finished kind of flat. So it tried to stage a rally up over 53, couldn't do it, reversed back down below 53, and we're at 52.5, give or take, right now. Either we're going to go sideways to build energy for another run higher. So by that, what I mean is we could go sideways for a few days, and that would build up energy for another move higher. That's possible. Or crude oil is going to stall out, and it's going to actually turn back down lower and go down to retest either 51 or lower. And so right now we're in the middle of the range. Same thing that applied last week, or same thing that applied last week applies today, which is we're in the middle of the range. There's nothing to do here. We want to at least potentially consider a trade down below 49, or if we can build some energy, go sideways for a while, we may have a trade to the upside, But barring those two scenarios, right now, here today, there's no trade in crude oil. I would have to favor, and I do favor, the downside in crude oil right now. Unless we got above and stayed above 53, there's downward pressure coming in crude oil. As long as we stay below, specifically 53.79, which is this bearish pattern here. So you have this down move, and this is essentially a bearish wedge pattern. That will generally also play out to the downside. So there's bearish undertone, there's bearish evidence in crude oil today. So longs, leave it alone. Anybody short, closing daily and hourly, or first hourly and then daily above 53, and you most likely want to move out. But you can be short if you're already short against that. It's not for me. I wouldn't do it, but I wouldn't be long. Short was the only thing I would be today if I had to have a position. That would only be with a gun to my head. We're in the middle of a range. For me, it's a no trade. Let's go take a look at the bond market. Here's the 30-year U.S. Treasury bond. Now, we made another run today for the 154.2 area, came up short and backed off, but still closed relatively strong in the bond market. So here's a bullish pattern that has seemed to have, at least numerically speaking, for the most part played out, only it's still bullish, and there still could be more upside coming. If we can get above hourly and close above 154.2, then there will be more upside in the bond market. As it stands right now, I think there would be, or the likelihood of more downside pressure in the bond market if we can't get above and stay above 154.2. We made basically, in my book, the way I look at it, 3 attempts at that, came up short 3 times. It's likely we turn back down unless they can get it going, rally fast, get above 154.2 and stay there. Then there's higher prices. As it stands now, as long as we're above the 50-period moving average, it's slightly bullish, but there's a lot of room in between where we are now and the 50-period moving average, which comes in below 152. I wouldn't be long the bond market at this point in time. I wouldn't be long. I wouldn't necessarily be short. I just think the pressure is to the downside in the bond market. Where would that downside be? Down to the bottom end of the current and recent range, which is about just short of 152, 151.10 to 152. That's where the market would likely trade down to if we turned back down and broke this bullish flag or wedge pattern, or bullish pattern, if you will. Let's take a look over at the dollar. The dollar got hit pretty hard today. I think it's in pretty simple terms. All we're doing is coming back down to 100 cents on the dollar. We've discussed this for probably 4 or 5 days in a row, maybe 99.50, and that's at a point in which we're likely to find a reversal take place and the dollar to once again trade to higher prices. Right now, there's probably a little more downside to come in the dollar, but we're getting close to finding another interim low in the dollar, but we might have room to the downside all the way to 99.50. 100 to 99.50. What was the low today? Which was 100.235. So we're close to par. We're close to 100 cents on the dollar. Most likely we get there. So we'll see what happens over the next day or so. Keep your eye out this week. It's Options X, inauguration, shortened week. If they're going to make a move, it's a compressed week. They'll likely get it done in rapid fashion. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.